In 1980, a benefits consultant named Ted Benna was scanning a boring update to the Internal Revenue Code when he stumbled upon a technical footnote known as Section 401k. It was never intended to be the foundation of a national retirement system. It was a tax break designed for high-level executives to shield their bonuses. But Benna saw a glitch. He realized corporations could use this footnote to kill off expensive pensions and shift the entire burden of retirement onto the employees themselves. Today, the man who discovered that paragraph looks at the $35 trillion sitting in these accounts and calls it a monster. He didn't create a safety net. He created a system that rebranded insecurity as freedom. My goal today is to show you why your 401k is not the ironclad vault you've been led to believe. It is a historical accident that has become the greatest transfer of risk in human history. Right now, millions of people feel secure because their balance is going up, unaware that the system holding that number is more fragile than a glass house in a hurricane. Not knowing the mechanics of this monster is costing the average worker hundreds of thousands of dollars in hidden fees and lost autonomy. To understand where we're going, we have to look at the deal we lost. For most of the 20th century, the deal was simple: the pension. It was a defined benefit plan where the company took the risk. If the market crashed, the company still had to pay you. Your only job was to show up and work. It provided a level of stability that is almost impossible to imagine today. But by the late 70s, corporations were looking for a trapdoor to escape these massive future liabilities. They found it in Benna's footnote. The 401k was a psychological masterpiece. It told workers they were in control. It told them they had choices. But what it didn't say was that by taking control, they were also taking 100% of the risk. If the market drops 40% a year before you retire, that's your problem now, not the company's. We traded a seat at the table for a ticket to a casino where the house always wins. Within a decade, the pension was a relic, and the American middle class became an army of amateur, forced hedge fund managers. This brings us to the first silent tax, the forced buyer effect. Every 2 weeks, millions of 401k accounts are automatically credited. That money must be deployed immediately into a pre-selected menu of funds, regardless of whether the market is at an all-time high or fundamentally rotten. This creates a massive, artificial floor for stock prices. Wall Street loves the 401k because it ensures a constant stream of buy orders that keeps the machine running and the fees flowing. But for you, being a forced buyer means you are often buying at the worst possible time, when assets are most expensive.
Robert,
simply
let me
because
introduce
your
you.
payroll deduction has no brain.
Hello.
Consider a
He's our
typical
new
investor
investor.
we'll call Robert. Robert is 45 and feels safe because his target date fund looks official. He doesn't realize that his fund is often just a bundle of other high-fee funds managed by the same provider. He is paying fees on top of fees. By the time Robert reaches 65, he will likely have paid more in administrative costs than he realized in actual market outperformance. The employer match he's so proud of? It's a bribe. It's the price the company pays to walk away from the liability of his future. They give him 3% today, so they can save 20% on the cost of a pension tomorrow. This lack of transparency is the primary feature of the retirement industry. If people truly understood the math of fees and the reality of risk transfer, they would demand a different system. But as long as the statements look green, the monster stays in the basement. It is only when the tide goes out, as it did in 2008, that the true nature of the 401k is revealed. A system that works beautifully for the institutions and leaves the individual holding an empty bag when the math stops making sense. Let us talk about the illusion of choice. When you sit down with your human resources representative and they hand you that packet of investment options, they call it a menu of opportunities. They use words like empowerment and self-direction. But if you look closely at how that menu is constructed, you will see that it is not a buffet designed for your health. It is a vending machine designed for the profit of the provider. Most employees do not realize that their company chooses their 401k provider based on one primary metric: how much it costs the company to run the plan. The big banks and insurance companies often offer to run these plans for zero cost to the employer. But in the world of finance, there is no such thing as a free lunch. If the employer is not paying for the service, you are paying for it through hidden fees and proprietary funds with inflated expense ratios. This creates a systemic conflict of interest. The provider fills the menu with their own captive products funds that often underperform the market but generate guaranteed income for the institution. You are trapped in an ecosystem where your only choices are the ones that make the bank the most money. This structure places a disproportionate burden on you. You are expected to be an amateur economist, a part-time portfolio manager, and a forensic accountant in your spare time. The industry expects you to navigate dense prospectuses, compare expense ratios, and understand the nuances between growth and value funds. Most people do not have the time or training for this. The financial industry counts on that. They count on your confusion and your inertia. By delegating the responsibility to you, corporations have washed their hands of any obligation to the outcome. If your portfolio fails, the official narrative will simply say that you chose poorly. Now consider the tax deferral trap, the central pillar of 401k marketing. The promise is seductive: save now and pay taxes later when you are in a lower tax bracket during retirement. It sounds like pure mathematical logic. But if we perform a forensic audit on that premise, it falls apart. For this strategy to succeed, you must accept two massive assumptions. First, that you will be poorer in retirement than you are today. If your goal is to maintain your lifestyle or grow your wealth, this is a depressing starting point. Second, you must assume that government tax rates will remain stable or move lower over the next 30 years. Look at the economic reality through the eyes of a money historian. The national debt is at unprecedented levels. The unfunded liabilities for Social Security and Medicare are measured in the trillions. Does this look like the landscape of a government that will lower taxes? By deferring your taxes in a 401k, you are entering into a forced partnership with the IRS, where they have the unilateral power to decide their share of your profits 30 years from now. You are building your wealth on a foundation of fiscal uncertainty. The government allows you a small deduction today to secure a claim on a much larger pool of capital in the future. They do not take the market risk, but they have a guaranteed slice of the final result. You are essentially giving them a signed blank check on your life's effort. This leads to what I call the Curfew Asset. The 401k is the ultimate form of a liquid capital. It is locked behind a wall of age restrictions and tax penalties. If you need your own money for a medical emergency or to seize a unique investment opportunity during a market crash, the system punishes you with a 10% penalty on top of ordinary taxes. This lack of liquidity creates a dangerous psychological trap. Because you know you cannot touch the money, you stop paying attention to it. You become passive. That passivity is what allows Wall Street to continue extracting fees for management that often fails to beat a simple passive index. Your capital is held hostage in a system that prioritizes institutional stability over your personal autonomy. You are a passenger on a ship where the captain has already secured his own bonus and lifeboat, while you are forbidden from stepping on a dry land until the calendar allows it. The 401k was not designed to liberate you, it was designed to keep you as a predictable and captive taxpayer within the global financial system. It was the tool that allowed companies to stop worrying about your future so you could spend your present worrying about their stock price. Sit with that for a moment. Every time you check your balance and see a number that makes you feel safe, I want you to ask yourself, who actually owns that safety? Is it you, or is it the senior partner waiting at the finish line to take their cut of a pie you spent 40 years baking in a kitchen they owned? Whenever the market begins to shake, the financial media and your 401k provider repeat a single mantra: stay the course. They show you historical charts that look like a smooth upward climb from the bottom left to the top right. They tell you that as long as you have a 20-year horizon, today's volatility is irrelevant noise. But as a historian, I have to point out the fatal flaw in that comfort. The market may have a multi-decade horizon, but you have a sequence of returns risk that can destroy you in a matter of months. If you are 60 years old and the market drops 30%, you don't have 20 years for the average to work its magic. You are entering the withdrawal phase where you are forced to sell assets at their lowest prices just to pay for your groceries. The stay the course advice is perfect for the fund manager who wants to keep collecting their fee on your balance. It is not designed for the human being who needs that capital to survive. This leads us to the nominal illusion. The numbers on your screen are a form of financial hypnosis. For decades, we've been told that $1 million is the magic threshold. But look back to 1980, when Ted Benna was first experimenting with Section 401k. Back then, $1 million was an astronomical sum. Today, in most major cities, it barely buys a modest home and funds a middle-class lifestyle for 15 years. The industry sells you a goal, but they don't adjust that goal for the reality of purchasing power. Think about the character of Sarah. Sarah is 30, and her brokerage website shows her a projection, $3 million by age 65. It looks spectacular on a bar chart. But if we apply a modest 3% annual inflation rate, those $3 million in the future will only have the purchasing power of about $1 million today. And that assumes taxes stay the same. Sarah is making massive life sacrifices to feed a machine that promised her a result it cannot mathematically deliver. She is trading her youth for a pile of paper that is being slowly burned by the very institutions that issued it. This is the tragic core of the retirement illusion. We focus on the score rather than the game. Wall Street thrives on this confusion. They take their fees based on the nominal balance. If your account goes from 1 million to 2 million, but your purchasing power stays stagnant because the currency shrank, the fund manager just doubled their income while your lifestyle remained the same. They are incentivized to cheer for the higher number even if that number is an inflationary hallucination. This is why the historian's perspective is vital. We can see that the current model is an outlier, a 40-year experiment being tested by conditions it was never designed to handle. The transition from pensions to 401k was not an evolution of financial wisdom. It was a strategic retreat by the corporate world. They realized the future was becoming too expensive and volatile to guarantee. So they packaged that volatility and sold it to you as an opportunity. They gave you a colorful user interface and told you that you were in charge of your destiny. But you cannot be in charge of your destiny if you don't control the money supply or the tax rates. You are a minority shareholder in your own life, and the majority shareholders, the government and the financial industry, get paid first, regardless of the outcome. This passivity is the fuel that Wall Street runs on. They need you to be a buy and hold investor because holding is what generates the steady stream of administrative revenue that funds their glass towers. Your forced participation is the glue holding the valuation of the stock market together. You are the liquidity that the big players use to exit their positions when things get dangerous. The 401k creates a false sense of permanence, making you feel like you're building a mountain of stone when you're actually building a mountain of sand. Sit with that for a moment. You are not just saving. You are underwriting the stability of a system that would sacrifice your account balance in a heartbeat to save a major bank. We move now to the end game of the 401k experiment. After 40 years of feeding the monster, you finally reach the finish line. But this is where the system reveals its final layer of control, the required minimum distribution, or RMD. Up until this point, you were told you were the owner of your account. But the moment you reach age 73, the government steps in and reminds you that they are actually the senior partner. They command you to start taking money out, whether you need it or not, and regardless of whether the market is up or down. The RMD is the government's way of ensuring they finally get their cut of that tax-deferred liability you've been carrying. They've waited 40 years for this moment, and they are not interested in your financial strategy. If the stock market has just crashed and your account is down 40%, the IRS doesn't care. You must still liquidate a specific percentage and pay taxes at whatever rate is in effect that year. This forces you to sell assets at the worst possible time, locking in losses that can never be recovered. Your 401k, marketed as a tool for independence, is actually a tool for government cash flow management. This creates the mathematical trap I mentioned earlier, the sequence of returns risk. In a pension, the company managed this risk. They had the scale to absorb a bad decade. But as an individual, a single bad 3-year window at the start of your retirement, combined with forced RMDs, can mean the difference between a comfortable life and outliving your money by a decade. You are withdrawing capital while the underlying assets are shrinking, which means you have less capital available to benefit from any eventual recovery. It is a death spiral that the 401k is structurally incapable of preventing. And what about the safety net we were all promised? The famous 4% rule. The idea that you can safely withdraw 4% of your portfolio every year and never run out of money. As a historian, I have to tell you, The 4% rule was based on a specific, anomalous period of American history. It was born in an era of massive industrial expansion and high interest rates. In a world of high national debt, lower growth, and volatile inflation, the 4% rule is not a law of nature. It is a dangerous assumption. Relying on it today is like sailing into a Category 5 hurricane with a map from a different ocean. Ted Benna's monster has grown so large that it now dictates the behavior of the entire global economy. Because so much of the middle class has their entire future tied to the S&P 500, the Federal Reserve is effectively forced to prop up the stock market at all costs. If the market stays down for too long, the retirement system collapses. This creates a massive moral hazard. We cannot allow the market to reflect reality because reality is too painful for 401k holders to bear. So, we print more money, lower rates, and create more inflation to keep the nominal numbers going up. We are burning the house to keep the occupants warm for one more night. You have to ask yourself, who does this system truly serve? Does it serve the worker who is terrified of their statement every time the news mentions a recession? Does it serve the retiree forced to sell shares during a panic to pay a tax bill? Or does it serve the institutions that have successfully outsourced all the risk onto your shoulders while retaining all the fees for themselves? The 401k has been a magnificent success for the corporate balance sheet and the Wall Street bonus pool. For the American worker, it has been the most successful bait and switch in the history of capitalism. Sit with that for a moment. You have been trained to be a good soldier in a war where you are the only one who can actually die. The fund managers will be fine. The IRS will be fine. You are the only participant whose survival is contingent on a set of assumptions that are currently being shredded by the reality of the 21st century. The monster isn't just in the tax code. It's in the very way we've been taught to trade our life energy for a digital promise that the system has no structural capacity to keep. So where does this leave you? If the system is an accident of history and the mechanics are designed to extract your wealth through fees and inflation, how do you move forward? The most dangerous thing you can do after hearing this is to do nothing. But the second most dangerous thing is to react with pure panic. Wall Street and the government count on your two primary emotional states being either total passivity or total terror. As long as you are swinging between those two extremes, you are easy to manage. To reclaim your sovereignty, you have to step outside that binary. You have to stop being a participant in a plan and start being the architect of a strategy. The first step is a cold, forensic audit of your own accounts. Most people have no idea what they are actually paying. They look at their balance, but they never look at the expense ratios of the underlying funds. You need to find the leak. If you are in a plan with limited options and high fees, you need to calculate exactly how much of your life energy is being siphoned away every month. If your employer match is the only reason you are there, then contribute only up to that match and no further. Do not give the machine a single dollar more than is necessary to capture that corporate bribe. Every dollar beyond the match is a dollar that could be working for you in an environment where you have actual control and actual liquidity. Think about the difference between a curfew asset and a sovereign asset. A curfew asset is one where the government or a corporation gets to decide when and how you can access it. Your 401k is a curfew asset. A sovereign asset is one where you hold the keys, a brokerage account with low-cost index funds, real estate, or a business. The goal is to create a balance of power in your own life. You may decide to keep your 401k for the tax benefits, but it should never be your only engine of survival. It should be a secondary tool, not the foundation of your house. Ted Benna never meant for his footnote to be your only hope. He envisioned a three-legged stool of retirement where the 401k was a supplement to a social security system and a corporate pension. We have tried to build a civilization on a one-legged stool, and we are surprised when it starts to tilt. To fix the math, you have to build the other legs yourself. You have to prioritize liquidity and tax diversification. The most reliable investment you can make is not in a target date fund. It is in your own ability to generate income independent of a single employer. Your earning power is the only asset that the 401k monster cannot directly liquidate through a management fee. As a historian, I can tell you that periods of greatest wealth creation were not characterized by people waiting for a mutual fund to save them. They were characterized by people who took direct ownership of productive assets. They understood that the currency was a tool, but real wealth is the ability to command resources and time. The 401k system has spent 40 years trying to make you forget these basic truths, turning you into a consumer of products rather than an owner of capital. It has tried to make you believe that complexity is a sign of sophistication when it is actually just a tool of opacity. The monster is large, but it is not invincible. It requires your compliance and your silence to function. The moment you start asking questions, the power begins to shift. You are not a victim of this system unless you choose to remain ignorant of its mechanics. You have the sovereign right to decide that your life energy is worth more than a footnote in a tax code. Ted Benna is a reminder that a single realization can alter the destiny of millions. My hope is that your realization today, the recognition that your retirement plan is a transfer of risk disguised as a gift, will be the starting point for your own transformation. If you found value in this forensic audit, consider subscribing. I make videos like this every week to help you navigate the truth behind the numbers. My goal is to help you maintain your sovereignty in a world designed to take it from you. Comment below with your experience. Did you know the origin of the 401k? Are you checking your fees today? The system is complex, but the truth is simple. Don't let the noise drown it out. Thanks for listening. I'll see you in the next one.